Well, hello again. Welcome back to Money Drive. And I had a thought this morning for a lot of you that are sitting watching the market and you see it's dumped 10%. If you're in the tech market, it might be 15 to 20%. And you're sitting there, if you're retired or you're close to retirement, you're probably worried. And I'll bet you anything, if you reach out to your financial advisor, the only thing that they're going to tell you is, well, stay the course, stay the course. Well, that sounds really great, except if you stay the course and you run out of money, where will this financial advisor be? Is he going to start supporting you? Is this financial advisor going to make up the difference? See, the unfortunate thing in the financial advisory business, advisors are taught by their companies just to keep you in, because if you get out, you could lose out. Don't disagree with that whatsoever. There are 3 days in the average trading cycle of a year that have the biggest gains. If you're out of the market, you're going to miss out on those gains. However, just staying in the market with a bad plan is not a good plan. One of the problems with our entire financial advisory business, and listen, I'm a part of this industry, but I've been very disappointed over the last 40 years. One of the disappointments that I've had is that the financial advisory companies are still using this whole, do you feel moderate, conservative, or aggressive? I mean, what the heck is that anyway? I mean, I've often said this. I raised now 5 kids, and when they get to the teenage years, their mental acuity as far as how do they process risk does not change until they get older. Well, that's the reason why, males 16 and 18 have incredible insurance rates, because they don't process risk the same way. So then I beg the question, how do you know that the financial advisor that you are saying, I want something moderate, how do you know that they're applying the same definition of moderate to what you consider moderate? It's a real dilemma, because sometimes it's matched up, but sometimes you see your entire portfolio dump down 10, 15, 20%, and you call the financial advisor and you say, hey, I thought I was moderate, and what they tell you is, well, you are. You're 50-50, stock, bond, whatever it is. But the problem doesn't occur with the market fluctuations. The problem occurs because you don't have a reverse engineered cash flow plan. And what I mean by that is you have to make a decision. And the decision is how you plan. And so if you have, say, the typical 98% of the entire financial industry runs off of something called Monte Carlo. It's a simulation program software that will run through, depending on the software that you use, anywhere between 1,000 and 10,000 iterations. It means it just keeps running calculations. And then what it does is it compresses them down into averages. And we all know what Zig Ziglar said about averages, right? Zig Ziglar, bless his soul, he's now passed away, but he had a great saying about averages. If you put your left foot in a bucket of scalding hot water and your right foot in a bucket of ice, then you on average should feel comfortable, but you're not going to feel comfortable. And that's kind of what happens when you use this Monte Carlo simulation. What I'm going to do is I'm going to put a little way to contact me. I have a study that was done on the massive failures in people's financial lives using Monte Carlo. And again, this is what 98% of financial advisors do. They'll put all your data in. They'll tell you that they're going to use your cash flow that you need to live on. And then they come up with what they call a confidence level. The confidence level, just protect against their liability, is never 100%. It's somewhere in the 70 to 90%. And what they will tell you, as long as you're above 70%, everything is fine. This is like the easiest, what I call it is the McDonald's duplication factor. And what I mean by that is, McDonald's created a system that was so simple, stupid, that they could put a 16-year-old in front of a screen, because all they had to do is press a button and say, Big Mac, add fries, large or medium drink. And the financial industry has done that same thing with the Monte Carlo simulation. They've used it as a crutch so their financial advisors can just press a button and go, hey, you're fine, you're above 70%. But they don't even understand the underpinnings of how that statistical analysis came about. The other thing that is rarely discussed with people about the failures of Monte Carlo is what's called the negative sequence of events. I know, give it to some financial professor to come up with that, right? Negative sequence of events means that you can run all the simulations that you want, and all it's doing is it's working out the averages based upon historical price fluctuations. Has nothing to do with, let's say that you retire on Monday and on Tuesday the market drops 25%. Well, statistically, on average, that should not have happened, but it did because of your timing. Again, negative sequence of events. The negative sequence is the market dropped not on average. It dropped at a timing that wasn't right for you. And so you, again, as I started this video this morning, is you have to make a decision whether you buy into this Monte Carlo fluff and stuff of your confidence level, or you work with real math, real numbers. And what I mean by that is you reverse engineer the cash flow that you need. We know by looking at the volatility of different investments. Volatility will usually have characteristics based upon the type of investment. So, savings account, zero volatility, but you lose money because after tax and inflation, you don't make anything. Bonds, very low volatility, but you might just break even with inflation. Stocks, volatile anywhere between 20 to 60%, but there's what I say is time heals volatility, as long as you're not buying single stocks. Now, when you buy single stocks, you run into what's called individual position risk. You know, if you bought, say, a stock and it just completely went belly up, you can't say, hey, time heals all. Now you have to get into much more of a statistical analysis of that actual stock. But if you have a basket of stocks, now I used to say this with all the confidence, that as long as you just used index funds and the right combination thereof, you'd be fine. But now the mutual fund industry has infiltrated the ETF world. So now you can't even tell if you have a real index or you have an actively traded index, which is no different than a mutual fund. We're going to make the presumption in this conversation we're having that you're going to use pure indexes. So I'm not suggesting individual stocks, but if you have pure indexes, and now you have thousands of stocks or thousands of bonds, maybe with a contained group of maybe only 10 to 12 ETFs, now I can with confidence say time heals volatility. Meaning that we know that you have less than a 20% statistical chance of losing money in the stock market at the 10-year point. At 15 years, it goes down to 7%. At 20 years, it goes down to less than 1%. But now, most people listening to this, they're probably retired or selling their business. They want to make sure that they don't have to wait 10 to 15 years. So, again, two schools of thought. One is you decide that you're going to buy into this Monte Carlo stuff, fluff and stuff I call it, or you reverse engineer your cash flow. Now, you still need a pretty high-end software to compute this, but basically what you're going to do is you're going to measure your need for income in time periods. So the first 5 years, we can measure what your actual expenses are, and then what we do is we place enough money in those investments that don't have risk, don't have volatility for the first 5 years. We also know that certain investments, it could be intermediate long-term bonds, it could be preferreds, convertibles, even some of the blue chip dividend stocks, we can place them into a 5-year bucket because they measurably have a certain amount of volatility. So when you are out of money in the 5th year, we turn it over to bucket number 2, which is the 5 to 10 year. And then finally, whatever is left over and not needed for the first 10 years of your life or of this strategy, you can put into the 3rd bucket. The 3rd bucket is the stocks. Wouldn't it be a wonderful feeling if you could wake up in the morning and you see the stock market drop by 20%? You're like, I could care less. I mean, basically, I got 20 years or I got 10 years or whatever it is that your structured bucket is working to not even worry about the volatility because you know everything is taken care of for the next 10 years. And really, I want to cap off today's, money drive with, it really depends on what you're looking for. If you're trying to hit the big home run with lottery by picking the next Google, hey, stick with what the financial advisors are telling you. Only 1 in 3,000 actual make it into a big stock. Or if you're more concerned with a logical, effective asset positioning strategy, then what I want you to do is, I'm going to put this in this video. I haven't done that before, so we're going to figure out how to do that. You can click on it, and what I'm going to do is I'm going to take you to another little video that will hopefully help you understand what I'm talking about with these 3 buckets. Hey, I hope this has helped you today. Signing off. Stop recording.